Atlas Energy Solutions, Inc. NASDAQ, AESI, Due Diligence Report Date. September 2025 Executive Summary. Industrial Services and Energy Infrastructure Company focused on propant sand logistics, power generation rentals, and oilfield pipeline support. Q2 2025 revenue, $288.7 million. Market cap, around $1.30 to $1.4 billion. EV near $1.70 to $1.8 billion. Strategic asset, Dune Express, a 42-mile electric conveyor system to transport sand. Execution risk and cost overruns have been key investor concerns. Dividend, quarterly cash payout, most recently 25 cents share. One company overview and business model ticker, AESI NYE. Core activities. Core activities, propant logistics, Dune Express conveyor. Power generation rentals, oilfield services. Model, heavy CapEx infrastructure aimed at lowering per ton costs versus trucking. Revenue from sand throughput, rentals, and services. To industry and market position sector tied to U.S. onshore drilling and fracking activity. Demand driven by proppant intensity per well and rig counts. Atlas differentiates itself through conveyor-based logistics versus traditional trucking. 3 revenue streams. Proppant throughput and logistics fees. Power generation rentals. Ancillary services. Equipment, construction, maintenance. For competitive advantages, proprietary Dune Express conveyor system. Vertical integration of logistics. Potential cost curve leadership if conveyor performs as planned. 5 scalability once conveyor ramps. Incremental throughput carries low marginal costs. Potential to replicate in other regions. No constraints. Upfront capital. Regulatory hurdles. Need for long-term customer commitments. 6 financial statement analysis revenue. Q2 2025 revenue of $288.7 million, beating some expectations. Profitability, margins pressured by high project costs, occasional EPS misses despite strong sales. Balance sheet, market cap, $1. 321. 4B, EV, tilde. $1.7-1.8b.net debt rising due to conveyor spend. Cash flow. Heavy CapEx has depressed free cash flow. Future depends on throughput growth. 7 key valuation metrics. Market cap, $1, 321, 4B, EV, tilde. $1.7-1.8b, PSTTM, approximately 1.0-1.1x PE, elevated volatile due to inconsistent earnings. 8 growth potential in TAM, US proppant logistics, hundreds of millions of tons annually. Growth drivers, more sand per well, higher rig counts, conveyor adoption. Risks, drilling slowdown, efficiency gains, reducing sand intensity. 9 competitor landscape direct, trucking fleets, regional logistics providers. Indirect, oil producers integrating logistics, alternative proppants. Competitive edge depends on per ton cost advantage. 10 management and governance leadership emphasizes conveyor ramp and Texas market expansion. Execution track record under scrutiny given cost overruns. Governance hinges on transparency in CapEx and contract disclosures. 11 risks, execution risk, cost overruns, or underperformance on Dune Express. Commodity cyclicality. Drilling activity swings affect sand demand. Customer concentration. Reliance on large buyers. Liquidity risk. High leverage and CapEx-strained free cash flow. Market sentiment. Short interest and volatility elevated. 12 dividends and shareholder returns. Quarterly dividend of 25 cents share. Dividend sustainability linked to throughput and free cash flow recovery. 13. Insider and institutional activity. Institutional ownership present. Stock actively traded. Monitor form for South and 13F filings for significant insider institutional changes. 14 technical analysis volatile trading in 2025. Stock reacted positively to Q2 revenue beat, but fell on execution concerns. Volume spikes tied to news flow, highlighting sentiment-driven moves. 15 recent analyst ratings and news. Bullish camp. Long-term upside from Dune Express once operational. Bearish camp, concern over execution, cost overruns, and margin pressure. Consensus. Mixed with cautious near-term outlook. Investment thesis bull case. Conveyor creates durable cost advantage, expands margins, and generates strong free cash flow once scaled. Bear case. Execution failures leave heavy fixed costs stranded, compressing valuation and limiting dividend safety.